mutual funds and mutual funds. Not a day goes by when we don't see a commercial on TV, on YouTube or on paper about why you should invest your money in mutual fund. But rarely is there a possibility that we know what exactly is a mutual fund or what are the different types of it. In my previous video, I told you about what exactly a mutual fund is. But now comes the question, what are the different types of mutual funds available in India? Hello and welcome to Finance for Millennials. My name is Arpan and in today's video I'll tell you all the different types of mutual funds available in India. Let's get started. Mutual funds are classified according to a variety of factors. Thus, before I go ahead and tell you all the different types of mutual funds available in India, let me list out the 5 major categories under which they are classified. The first category is structure. The second category is asset class. The third category is investment objective. The fourth category is specialty, and last category is risk. Under these 5 major categories, all the different types of mutual funds in India are classified. Now that you know the 5 major categories, let us move ahead and explore each of these categories in detail so that you as an investor are aware of all the different types of mutual funds available in India and the investment objective that each of them will fulfill. The first category under which mutual funds of India are classified is structure-based mutual fund. In this category, there are 3 main types of mutual fund: open-ended mutual funds, close-ended mutual funds, and interval funds. What are open-ended funds? As the name suggests, these funds are open for buying, for purchasing and redemption throughout the year. Thus, you as an investor can at any point in time invest your money into this, and if you feel so, you can withdraw your money as well. These open-ended mutual funds offer a lot of liquidity. The second type of mutual fund under this category is closed mutual fund. As the name suggests, this is completely contrast to the open-ended mutual funds. There is a specific date on which you can purchase units of this mutual fund, and a date will be given to you only on which you can sell back the units of the mutual fund. The initial date on which you can purchase units of this fund is known as the initial offering period. After that, your units are locked for a certain tenure of time, and only when the date comes can you sell back the units either to the mutual fund or on the stock market. The third category under structure-based mutual funds are interval funds. Now, interval funds offer you, the investor, the best of both worlds. They are structured with the pros of both open-ended mutual funds and closed-ended mutual funds. Like open-ended mutual funds, they also have an initial offering period during which you can purchase units of this mutual fund. After that, after certain intervals of time, the mutual fund manager will offer you a date at which you can either choose to sell back the units you hold of the mutual fund back to the mutual fund itself or on the stock market. Thus, interval funds are very liquid, and you as an investor have the freedom to invest as much money as you want, as well as take it out at any point. Ahead with the rest of the video, I just want to grab your attention for a second and tell you that if you like the information that I am sharing in this video, do consider liking the video, as it will help my channel grow. Along with this, don't forget to hit the subscribe button and click the bell notification next to it so that you get all regular updates from our channel. With that being said, let's continue to the rest of the video. The next category under which mutual funds in India are categorized is the asset class. Under this, there are 4 main types of mutual fund. The first is equity funds, second is debt fund, third is money market fund, and fourth is hybrid fund. So what exactly is equity fund? An equity fund is any mutual fund that takes your money and invests it in the shares and stocks of companies that are actively trading on the Indian stock market. These funds are typically very high risk funds and thus offer very high returns to you as an investor. The second one that comes under the asset class of mutual fund is debt fund. As the name suggests, this mutual fund takes your money and invests it in various debt instruments. Now, what exactly is a debt instrument? For example, take that the government of India needs some money for various of its projects. How does the government get that money? The government in India has 2 main vehicles to do this. The first is treasury bills and the second is commercial papers, also known as government bonds. In exchange for these bonds or treasury bills, you give the government a certain amount of money and the government gives you a certain rate of interest per annum. Debt instruments are moderately low risk and give you a steady income over time. The third type of mutual fund under this category is money market fund. Now, a money market fund is a mutual fund that invests your money in liquid investment vehicles, again such as treasury bills or commercial papers. They are typically very low risk funds and give you moderate to high returns. Thus, if you have a bulk amount of money that you want to invest in a mutual fund and gain a dividend or a return over time, money market funds are one of the best investment vehicles for you. The fourth and the last type of mutual fund that falls under the asset class is hybrid funds. As the name suggests, this is a fund that offers the best of all the three mutual funds I mentioned before this. They typically invest your money in both the equity market as well as the debt market so that the risk is moderate and you get moderate to high returns. If you are an investor who is looking to earn moderate to high returns and have the money to invest, then hybrid funds are one of the best investment vehicles available for you. Another thing to note is that all the mutual funds, or most of them that you see in the Indian market today, are all hybrid funds. They are one of the most common investment vehicles chosen by investors in India. Next category under which mutual funds in India are categorized is known as the investment objective. Under this investment objective category, there are 7 different types of mutual fund that are available to you for investment. These are the growth fund, income fund, liquid fund, ELSS or tax saving fund, capital protection fund, pension fund, and fixed maturity fund. Now that you know the 7 different types of mutual fund available under the investment objective, let us go ahead and explore all of this in a little bit more detail. The first one that we'll talk about is growth fund. As the name suggests, this fund is typically for those who want to grow their wealth over time. This is a high risk fund and invests your money in the equity market so that you get very high returns. You can either invest in this fund in the form of a lump sum money or even SIPs. But be aware, this is a very high risk fund and thus your chances of losing money are also there. The next type of fund under this is the income fund. Now, suppose you have 10 lakhs or 1 crore with you and you want to invest it in somewhere. If you go to the bank and invest it in a recurring deposit or fixed deposit, then the rate of interest you will be getting is only 5 to 10%, 5 to 8%, which is very nominal. On the other hand, if you take this bulk amount of money and invest it in an income fund, the mutual fund manager will take this money and invest it in both the equity market as well as the debt market, and which will give you a very substantial return on a monthly basis. Thus, if you have access to a bulk amount of money, the income fund is one of the most suitable mutual funds for you to invest in. This fund is generally categorized as moderate to low risk and thus the amount of returns you get is sufficiently significant. The third type of fund under this investment objective is the liquid fund. As the name suggests, the primary motive of this fund is to give you as an investor maximum amount of freedom and liquidity. Thus, this fund is categorized as a very low risk fund and you have the complete authority to invest your money anytime you want as well as withdraw it. This mutual fund typically invests your money in short or very short investment vehicles so that they can give you the option of withdrawing your money at any point in time. The fourth type of mutual fund that is categorized under the investment objective is the ELSS or the tax saving fund in India. As the name suggests, any amount of money that you invest in the ELSS fund is deductible under the Income Tax Act of India. Thus, if you want to save tax in the upcoming fiscal year, this is one of the best funds for you to invest in. The fifth type of fund that we will talk about under this category is the Capital Protection Fund. As the name suggests, the main motive of this fund is to protect the principal amount that you are investing. This fund is most suitable for those who have access to a lump sum amount of money and don't want it to get wasted sitting in a bank account. They want to invest it and earn a moderate amount of return on it. This fund is generally categorized as having moderate risk and thus the amount of return you get over time is subsequent. The sixth type of fund available to you is the fixed maturity fund. As you might have already guessed, this is a type of close-ended fund. Before you can invest your money in this fund, you are given a specific date and a specific return that you will get out of the fund. You cannot earn a huge chunk of money from a fixed maturity fund, and you cannot withdraw your money at any point in time according to your will. Thus, if you have a bulk amount of money and you have a plan of investing it for a set amount of time, then this is one of the best funds for you to invest in. The last and the most crucial fund under this category is the pension fund. As the name suggests, the fundamental objective of this fund is to invest your money for a very long period of time. Suppose you're 21 or 22 like me and you start a pension fund. Just imagine the amount of time you will be working for in the next couple of years. Easily it will be 25 to 30 years, and you invest a mere amount of 500 to 1000 rupees every month in your pension fund. Over time, that is a span of 25 to 30 years, there will be a huge principal amount that you would have invested, and on top of that, the mutual fund will invest your money in equity market as well as the debt market, so that the risk is moderate, but the returns you get as an investor are very high. The next category under which mutual funds are categorized in India is known as a specialty category. Under this, there are 13 different types of mutual funds available to you as an investor. They are sector fund, index fund, funds of funds, emerging market, international fund, global fund, commodity focused stock fund, and real estate fund. There is the market neutral fund, inverse fund, asset allocation fund, and the gilt fund. And last but not the least, there is the exchange trade fund. Now that you know all the 13 different types of mutual fund which are categorized under the specialty category, let us explore what each of these means for you. So the first option under this category is the sector funds. As the name suggests, this mutual fund invests your money in a particular sector. Now, this might be the real estate sector or the gold sector. The sector might differ from fund to fund, but the overall thing you need to understand is that your money will be invested only in a particular sector and not a mix of different sectors. The next type of fund under this is the index fund. Now, you must be aware of what an index is. This mutual funds invest your money on a particular index of the stock market. For example, the mutual fund might invest your money on the BSE Sensex and mirror its movement. Thus, if the BSE Sensex goes up, you earn a lot of profit, and if it goes down, it gives you a. The next type under this category is the fund of fund. Now, this is a really interesting one. As the name suggests, your money will be invested in another fund. Thus, a mutual fund is investing in another mutual fund. These are typically very low risk mutual funds, as the target fund on which your money is being invested has a lot of other investments under it. The next type of fund, or the fourth fund in this category, is the emerging market fund. Now, you might have already guessed from the name that an emerging market fund is any fund that invests your money in emerging markets that have potential to grow in the future, thus giving you a substantially high return. The fifth type of fund under this category is the international fund. As you might have guessed from the name, this fund only invests your money in foreign territories. This, in a way, is similar to the emerging market fund. The sixth type of fund under this category is the global fund. Now, you might be wondering what is the main difference between an international fund and a global fund. The main difference is, in an international mutual fund, your money is invested only in foreign territory and not in your home country. However, in a global fund, in this case, the money can be invested in India as well as a foreign territory. The seventh type of mutual fund under this category is the real estate mutual fund. In a real estate mutual fund, your money is invested in companies that are directly involved in the real estate business. The eighth type of fund is commodities stock focused fund. The first thing that comes to our mind when we hear commodity stock focused fund is that our money will directly get invested into commodities such as cotton, jute, petroleum, diesel, etc. But that is not the case. This mutual fund invests your money in companies that are invested in the business of commodities and not directly on the commodities itself. The ninth one in this list is a market neutral fund. The name market neutral fund is given to this type of mutual funds because they don't directly invest in stocks or shares of company that are trading on the stock market. but rather they take your money and invest it in fixed income vehicles such as TPs and CPs, so that your capital or the principal amount is protected and you get a steady source of income all throughout the tenure. The 10th type of fund in this category is an inverse fund. Now, this is one of the most interesting types of mutual fund in this whole list. So listen carefully. What happens in an inverse fund is that you need to have a very high risk appetite. When the market is doing well, you will take a loss. But when the market falls or the economy crashes, you will earn huge amounts of profits. So if you are an investor who wants to earn huge profits and have a high risk appetite, then inverse funds are one of the best investment vehicles for you to invest in. The 11th mutual fund that falls under this category is an asset allocation fund. Now, an asset allocation fund are of two types, the target date fund and target allocation fund. They invest your money in equity as well as the debt market. The 12th type of fund that falls under this category is the gilt fund. Now, what does a gilt fund mean? A gilt fund is any fund that invests your money in government stocks or bonds for a very long period of time. Thus, you do not get a very high amount of return, however, your principal is secured and you get a steady income source over a long period of time. The last type of fund under this category is an exchange trade fund. Now, what exactly is an exchange trade fund? An exchange trade fund is a passively managed fund with a low to moderate risk and invests and is directly traded in the stock market. This type of fund is a combination of open and close-ended funds, thus giving you the pros or the best of both worlds. Now, with this, we end the specialty category of funds. Now, the last category under which mutual funds are categorized in India is the risk category. As you might already know, there are three different types of risks available in mutual funds. There are the low risk funds, medium risk funds, and high risk funds. Now, what is a low risk fund? A low risk fund can be anything that has a low return and the amount of risk level is moderately low. Thus, your principal amount is secured throughout the tenure of the mutual fund. However, the amount of returns you earn is low. This can be either the debt market fund or even the government bond fund. The next comes is the moderate risk fund. Now, what is a moderate risk fund? As the name suggests, you as an investor will have a moderate risk when you invest your money in this type of fund. However, the amount of returns that you get will be moderate as well. Last but not the least is the third one, that is the high risk fund. Now, what exactly is a high risk fund? High risk funds are typically equity funds or funds that are investing in emerging markets or international markets. There are a lot of factors in play, such as political or economic factors, or how the economy has been performing in a specific country or your home country over a period of time. But one thing to note here is that if you have either a high risk appetite or you want to invest over a long tenure of time, then the high risk funds is one of the best for you. With that, we can conclude today's video. If you liked what I just shared in this video, don't forget to hit the like button. If you're new to the channel, make sure you subscribe and press the bell icon next to it so that you get all our notifications regularly. Thank you for watching until the very end and have a great day ahead.